Afternoon, everyone. We appreciate you being here. We will give it another minute or two just to give folks an opportunity to dial in or to join this session. So we'll wait till like 11:01 Pacific time, and then we'll get started. So please hang in there. All right, we're already at 11:01, and people can trickle in. That's fine. First of all, John and I would like to welcome you all to this MCT webinar, an introduction to mortgage banking. John is joining us from Las Vegas. He's attending the National MBA conference. So thank you for taking the time out of your busy schedule, John, to join us for this. For everybody, I'm Bill Shirreffs. I'm head of our MSR group. That's the mortgage servicing rights division. And then John is our director of margin management advisory. We both have, it's surprising and hard to believe, but we both have over 30 years of experience in the mortgage industry. Our career paths have been similar, but actually we do have some significant differences. And as a result, we hope to provide you with a very broad perspective during this webinar. John and I worked together at Fannie Mae, but John actually started his career as a loan officer. So he's got experience all the way from the very beginning of the process until the end. He has held a number of head of secondary marketing roles, responsible for pipeline management, to business development, market intelligence, and also margin management. And then for myself, I actually started my career at the tail end of the process in the REO division at Fannie Mae. You know, that's when things don't go well, when the borrower isn't able to hold on to their home and they go into bankruptcy or foreclosure. So, and John, if you wouldn't mind when I'm talking, I'll do the same for you. Let's go on mute because I am getting a little bit of an echo, and I'm not sure if that's coming from you. But the folks that are on the line, I think you're there. There you go, John. Thanks for doing that. So I also have, that REO experience, but capital markets. John and I both worked on the cash desk at Fannie Mae, ran national accounts for PMI, and then also ran loss mitigation. So a combination of the two of us, we've pretty much got every part of the process covered. Additionally, we both have provided extensive training for Fannie Mae and the MBA. I actually taught MBA 2 a couple of years ago, the hedging side, and John has done similar courses as well. Just a couple of housekeeping items before we jump in. As you probably already heard, as you came in, everybody will be in listen-only mode, but please take advantage of the chat function. Submit your questions if you have any. We'll be happy to address them as we move through this presentation. And then, as always, at the conclusion, our marketing team will get the presentation and the deck out to everybody that has registered for the course. So thank you for joining us again. Let's get started. So our plan during the next hour is really to touch on a number of topics and hit highlights and share our perspectives periodically. It's important to note that we might be sharing our opinions along the way. Those opinions don't necessarily reflect the opinions of MCT. So these are John's opinions and Bill's opinions. So we just wanted to make that clear. And this is really designed to be a broad introduction to the mortgage banking industry. For those of you that have been in the business for a number of years, I'm sure most of these topics will be familiar to you. But I'm confident that we'll explore some elements that are new and different. And then for those of you that are truly new to the business, our objective is to ensure that you're exposed to a number of topics that will be useful to you as you start your career in this business. And we were happy to have you in the business. So if you look at the agenda, we're going to talk about the key industry players, originator types, the different channels, how the mortgages are produced, and then we'll go through the origination process and what's important about that, and some of the key loan borrower characteristics and why those characteristics are important to have insight into. And then the execution decisions, when the originator decides whether to sell or to keep a loan, what are some of the considerations that they should be thinking about? and then the GSE mortgage market impact and the influence. And then ultimately, we'll talk about the financial crisis and changes that were made that were really the result of that crisis that we went through over 10 years ago. So that is our plan. Again, thank you for joining us. Let's jump into the first slide about the key industry players. Well, you really can't talk about our mortgage system without talking about Ginnie Mae and the GSEs. It really truly is unique. The United States system is unique globally in its scale and size, and we have an extensive system that is really designed to ultimately achieve strong liquidity for mortgage lending. It's purposely designed to provide consistent, predictable, reliable mortgage liquidity under all market conditions, good and bad. So if you look at Ginnie Mae, Ginnie Mae was established in 1968, and their objective was to provide home ownership opportunities for those individuals that might have difficulty obtaining a mortgage otherwise, and that would include first-time home buyers, it would include veterans, it would include low-mod type situations. So they, again, are fully government insured, backed by the U.S. The government, and they are a part of, they are under the direction of HUD, Housing and Urban Development. Secondly, the GSEs, they are actually sponsored by the federal government. They are government-sponsored enterprises. And Fannie Mae was actually created as a result of some of the challenges during the Great Depression. It started in 1938. And what you should know is that there was actually a run on the banks. And what that means is that there was a dramatic deterioration in the confidence in the financial system. And what borrowers were doing and what asset holders were doing, they were pulling their deposits out of the banks. And so the banks didn't have capital to lend to future homeowners that wanted to have a mortgage. So as a result of that instability, Congress created Fannie Mae in 1938 to address that, really to provide liquidity and sustainable home ownership opportunities for the entire country. So you also have introduced following Fannie Mae, also Freddie Mac. They are sort of dual entities, provide conventional solutions. And then you've got the federal home loan banks that work with banks and credit unions, and they actually can participate in both conventional and government loans, but they are specifically chartered to work with credit unions and typically on the smaller size and community banks. So those are the government-sponsored enterprises and the government entity of Ginnie Mae, which really provide the source of the liquidity of our financial system for mortgages. So with that, I'm going to turn it over to John to talk about some of the other key players. Take it away, John.
Sure, thanks, Bill, and great to chat with everybody here. And if you think of the GSEs and the government entities as mortgage enablers, think of mortgage originators as those, obviously, that take loan applications, pretty obvious there. We're going to get into some of the different types of originators later. But I think maybe what's a little less clear is mortgage servicers. They service the loan, but what does that really mean? So how I think about it, originators, application to the time a loan funds, a mortgage servicer, which could be a different entity, takes over after the loan is funded up until the time the loan is paid off. Mortgage insurance companies, Bill was at a mortgage insurance company, and exactly what it is, an insurance company that also insures, co-insures a loan, generally with Fannie Mae, Freddie Mac. Those tend to be higher loan-to-value loans. So if somebody's going to make a lower down payment, they need a little extra insurance. And those are some of the mortgage insurance companies, MGIC, Arch, Essent, Radian, and National Mortgage Insurance. Warehouse banks, they provide liquidity to those lenders that don't have deposits. They don't take deposits. So think of independent mortgage banks. Think of warehouse banks as providing funding to banks that don't have deposits, don't have their own money. They need to borrow money and lend that money out. Brokers, dealers, this is really an important part of the world that most borrowers don't see and a lot of us don't see, but the broker dealers are really the secondary market. They enable the sale of mortgages or mortgage-backed securities or pools of mortgages to buyers, and those buyers can be anybody. It could be insurance companies, it could be pension funds, it could be investment banks, any number of different buyers of mortgages. They enable the sale and purchase and liquidity of the mortgage market, which is tremendous for us all. And then I'll just mention vendors here as well. There's a whole constellation of vendors that provide services to make mortgage lending possible, whether that's appraisals or title insurance, credit reports, and there's literally hundreds of different vendors in our industry. Getting a little bit more detailed on independent mortgage banks, we say that they cannot retain loans in portfolio. That's actually not true. Sometimes mortgage banks make mistakes and they end up with loans in their warehouse lines and or in their portfolio, but they generally don't have a portfolio of loans. They are all about funding loans and then replenishing the funds and focusing on mortgages. Mortgage bankers are really known for high service levels. They're really get it done type of lenders and a really important part of the mortgage industry. National banks, think of big, Citi, Chase, B of A, Regions, Synovus, regional banks. What's different and important about them is really their ability to put loans into portfolios. So they can make mortgage loans that don't necessarily conform to the Fannie Mae, Freddie Mac, FHA, VA guidelines, and they can make loans that make common sense loans or maybe large jumbo loans that they want to put into portfolio. And I think what's really important, what's happened over the last 4 or 5 years, is that banks have become much more selective about those mortgage loans they want to put into portfolio. They really want to focus on those borrowers that bring additional value to the banks and the organizations. So think of checking accounts and deposits and CDs and other banking relationships. So you see a lot of things like doctor's loans. Why is that such a big deal for banks? Well, they want that doctor relationship. They want the relationship with the individual, not just the mortgage. So that's been a big development over the last few years. Community banks, where I really see them sticking out is in some of the local communities. They are the dominant lender. They are the brand, well-trusted, great lenders. Credit unions, not-for-profit organizations, they're member-based. What's changed there that I think is important is that credit unions, you may remember as mostly being associated with an employer. And a lot of credit unions have changed their names from the employer such and such credit union, and they're changing their names. You see that a lot because they're becoming more community-based credit unions. So more people are able to get membership at credit unions now than they did before.
And John, I see a question just got submitted around the market share distribution. And I can take it if you'd like me to, as far as these originator types. Yeah, so the question is, what would be the current distribution of production relative to these originator types in the current market? And right now, as far as the IMBs, it's roughly 50 to 60% of the total. Historically, that ranges from 50 to 65%, so it continues to be the dominant presence in the mortgage space. And then for banks, it's currently in the 15 to 30% range, and then credit unions 5 to 15%. Just to add to John's comments, one thing to keep in mind relative to the banks and the credit unions, and I'm sure you all know this, but they participate in lending beyond mortgages. So they're, even though the credit unions might have just a share of 5 to 15%, they're participating in car loans and in boat loans and a lot of other assets. And the reason IMBs dominate, that's their business. They have to dominate in that space. So anyway, hopefully that answers the question that was submitted, and let's keep going on to the channels. Right. So the 3 channels, and the question might be what's important about the channels, and the type of channel that's being used can affect a lot of different elements, such as the loan's performance, the risk exposure, the product mix, the profile. There are counterparty considerations if you're not doing a retail production. You have to think about the competitive landscape, the cost structure involved, expenses, how is the pull-through rate being impacted, predictability around that pull-through rate, the probability of pull-through, margins and returns, all of those things. So the three channels are the retail channel, the wholesale channel, broker model, and then the correspondent channel. So let's, I'll take the first one relative to the retail channel. So Jess, if we could move on to the next slide. And what's unique about the retail channel is that every step in the origination process is handled by the originator or the originator's staff. From loan application, you know, as I said earlier, John was a loan officer. That's really kind of the start of the process. Once that application is submitted, a loan officer will start working that application all the way through underwriting, all the way through funding and closing. So on the resale side, that entity has control of every step in the process. Historically, retail production has been viewed as less risky. If we think about what was happening during and after the financial crisis, the most risky channel at that time was the wholesale channel. There was a lot more fraud, a lot more misrepresentation that was uncovered in that channel, which has been addressed since then. That channel is performing very close to retail and very close to the correspondent channel now. But there have been periods where different channels perform differently. But perception-wise, retail has historically been less exposed to errors, less exposed to fraud and misrepresentation, which we experienced when I ran loss mitigation as well at PMI. A few other things, when you think about the retail channel, you know, you're driving down the street and you see these Chase branches, or you see Bank of America branches, that would be considered a retail operation, where you can actually go in and speak to a loan officer. You could actually submit your application on site. Banks and credit unions have the same situation, where they've got this branch structure and brick and mortar locations throughout the country. And then those operations have loan officers. Again, like I said, John was a loan officer for his company, and he represented them and just worked the loans that came through that operation. So he had full control over that, and he would shepherd that loan all the way to closing. He would, you know, talk to the underwriters, make certain that they have all the documentation that they need, and then ultimately hold the borrower's hand and bring that loan all the way through closing. So that's the retail channel. And with that, I'm going to turn it over to John to talk more about wholesale and correspondent.
Sure. So think about wholesale as you have a loan officer. It takes the application, but the loan officer is going to shop that loan and try to get the best deal for their client. So they're going to shop that loan around to different wholesale channel lenders. And they're really just like an insurance broker, or anytime you hear the word broker, they're trying to find the best deal for their client. Their role is to take the application, but the wholesaler, the actual lender, is going to underwrite the loan. They're going to fund it. They're going to service it. And you see a couple names here that you might recognize: Rocket TPO and United Wholesale, UWM. I would say one of the biggest developments in the last 10 years has been the growth of the wholesale channel, driven by those two lenders and many other wholesalers that have really succeeded considerably. The share of the wholesale market has really developed substantially, as Bill referenced in 2008. We'll keep on going back to 2008 because that was a great recession, and it was a really important milestone in our mortgage history. You know, wholesale lending was left for dead, and now it's very, very strong and robust. As for correspondent, which is the next slide, we'll shift to one more slide if we could. This is an important distinction. This is a closed loan. So think of a closed loan that's already funded. Now what are you going to do with it? You're going to sell it, you're going to keep it, what are you going to do with it? This is a business-to-business transaction. This is when a loan is closed. That loan represents a future income stream, and it can be sold from one company to another company. So when we think about closed loans, we think about lenders. This example, Guild Mortgage closes a loan. They're a retail lender, they fund it, and then they sell that loan and the servicing, which we'll talk about in a bit, to PennyMac. And then PennyMac will go do what they do, maybe securitize the loan or what have you. And that is a correspondent transaction. We're going to talk about servicing release in a little bit. But one of the things, again, in 2008, the correspondent channel, I would say the almost 2/3 of the correspondent buyers in the market exited the market in 2008. And then we saw a whole new regeneration of lenders over the last decade and a half or so. Names like PennyMac, AmeriHome, and such have really come into that market and provided tons of liquidity for not just mortgages, but also the mortgage servicing rights, which is an area that Bill cares greatly about. And I think a good example, Bill, maybe you could talk a little bit about the MCT marketplace is really where it provides a platform for lenders to do those types of transactions on the correspondent side.
That's great point, John. Yeah, we've got the largest whole loan trading platform in the industry, and what it does is it allows originators that may not have the ability or relationships with buyers to sign up on the marketplace and sell to a pretty significant list of buyers. And then on the origination side, if you don't have a large origination staff, you can actually buy loans on the platform. Using and leveraging that sort of as your sales force and your production capability. So it's a good point, John. Shall we proceed? All right, well, let's talk about the origination process, and I would say that it continues to be fairly complicated, but there are reasons for that. I mean, every step is intentionally designed to perform a function and ensure consistency, fairness, accuracy, compliance, legality. Some people would argue that it should be more efficient. It should be much easier than it is. And I would argue that if you're borrowing several $100,000 from an individual or from an entity, that it should be somewhat rigorous. It should ultimately be something that takes time to ensure that the appropriate borrowers are receiving the financing that they have earned. So that's again my opinion. I think it should be rigorous, and it's rigorous to avoid risk and to ensure fairness. So let's just look at each step. So the origination, the loan application process. So that's where the potential borrower would work with the loan officer, submit their application. The loan officer would order the credit report. They would submit the required documentation to the borrower. Then on the processing side, you've got the underwriting side has not received this yet. They're still gathering information. This is where the verification of employment, verification of income, a lot of these elements are tied to the QM and the non-QM that John will speak to a little bit later. But this speaks to the ability to repay and the criticality behind that. And then once everything is gathered, then it goes to the underwriter. This is an expert. What they would do is typically leverage an automated underwriting system like Desktop Underwriter, Loan Processor, and then they would get a loan prospector. Then they would get results from the AUS. Again, that's automated underwriting system. Then they would verify the credit, analyze the income. They would also make certain that the appraisal was appropriate to support the financing that's being requested. Then it would go to closing. And they would check, validate everything that's in the package and complies with investor guidelines. So they would check the fees, review all the disclosures. And the disclosures, obviously, there's significant legal exposure. If the disclosures aren't executed or they're not all there, that would create legal risk that is critical. And then the closing instructions. And then ultimately funding. They would again verify the documentation. They would send the funds, they would wire the funds, they would ship the notes to the warehouse bank. So then ultimately it would go to shipping and delivery. They would send all of this information to the investor. And then once all of that has happened, the loan has been sold, then you would have an asset called the MSR. That's the servicing asset. And that's the group that I run at MCT. That's where a strip, it's an IO strip off of the note rate, is paid to the servicer perform functions. They process the borrower payments. They do the investor reporting. They ensure that the borrower is making their payments in a timely manner. That they make certain that all of the legal requirements are adhered to. So that's servicing function. And again, I would say that every step is necessary to ensure fairness, to ensure that the borrower is equipped, and that the loan ultimately is a sustainable home ownership situation, and we're not putting borrowers in situations where they are going to be stressed financially and not able to make it. So the question that I have here, and I think John, maybe you could answer this as far as like, when does the originator actually take on risk, specifically to the interest rate risk? At what point in the process does that happen?
Yeah, so step number one, application, and typically borrowers are not going to want to have interest rate risk. I mean, they take an application, the interest rate is 6.5%, they're going to want 6.5%, right? So generally within a day or two of the application, step number one, the borrower is going to lock in their interest rate with the lender. So the lender is going to make a guarantee to the borrower, hey, for the term of this processing, step 1 through 5, we're going to guarantee you get that 6.5% note rate. Now, some things can happen in between, but generally speaking, that happens and everything works out 80% of the time or so. But what's really additionally interesting, I think, is that steps 1 through 5, historically, that's what is an escrow for a house? 60 days for an escrow, 45, 60 days for an escrow for a house. That's the loan period, right? But when we had all those refinances back in the early 2020, 21, and 22, that processing time, step 1 through 5, went from 30 to 40 to 60 to 70, 80 days. And in some instances, lenders just stopped taking applications, right? Because they were just so filled up. And it's just a huge reminder that this all looks great on a slide and everything, but in practicality, we're in such a cyclical business that a lot can change, and there's a lot of complexities around doing all this because things change and loan volumes change all the time.
Yeah, that's great. And just to add to that, when that interest rate risk is accepted, that's when the originators are taking on that market risk, that interest rate risk. So if they offer the borrower 6.25 and they don't do anything relative to protecting their position, they're exposed to market movement. And that's when hedging, the concept of hedging comes into play, where the originators are taking out a position to offset that exposure and really protect their margin. At the end of the day, that's the objective of hedging, to protect their base margin and make certain that that's not exposed. So we can speak about that a little bit later, but we'll keep moving here. So let's talk about all of these elements. I'm very familiar with relative to my experience at the PMI and John and I at Fannie Mae. Each component contributes to the loan's anticipated performance, and performance can be around delinquency performance, able to maintain their payments, through to the end. It could also mean prepayment exposure and ultimately risk exposure and exposure relative to pricing levels. So let's just take a look at each of the elements here. So the units, 1 to 4 units is considered residential. And all of these are considered eligible for the GSEs. Everything over 4 units is considered multifamily. But from a risk perspective, a 4 unit is considered more risky than a 1 unit, because you just have a lot more elements involved that will increase the risk there. And then occupancy, you've got owner-occupied, primary residence, and second home and investors. As you would suspect, an investor loan would be more risky than an owner-occupied loan. And that's because the investor loan, they probably already have another primary residence. So if the market goes south, the investor isn't going to fight as hard to make their mortgage payment as someone that actually lives in their home. So the risk of the investor loan is greater than an owner-occupied loan, and therefore the underwriting parameters around those types of loans are different. Then you've got property types, same kind of thing. Detached is going to be less risky than a condo. Just again, more elements involved. You've got neighbors with the condo, you've got common walls, you've got HOA fees. Manufactured housing is more risky than detached. And then the mortgage types, you've got purchase money, rate income refi, and cash out refi. Cash out refi, you know, if the borrower is taking money out, they're actually eating into the equity position that puts the investor in a good spot relative to risk. So that would result in greater risk. And cash out refi would be considered more risky than a purchase money loan. And then the loan to value ratio, it's obvious, but obviously a 95% LTV loan is more risky from a performance perspective than a 70% LTV loan. Less equity, less skin in the game, increases the likelihood of default. And then the credit score, the higher the credit score shows that the borrower has been able to manage their finances effectively, and therefore their risk on the mortgage side would be lower than someone with a lower credit score. And what has changed over the last 15, 20 years is the pricing has gotten a lot more granular relative to risk-based pricing. There used to be just flat pricing across all credit scores, across many of these different characteristics, much more granular today, and it's getting more granular all the time. As we get more data, more insight into performance, sellers and buyers are becoming more familiar with how do we get the most accurate price we can for each individual loan. And then the debt to income ratio, this is the one that has always sort of surprised me, is that it is a gross calculation. It doesn't include tax implications yet. So somebody with a 50% DTI means that 50% of their gross income is dedicated to their mortgage payment. So you factor in, the taxes, much lower amount of disposable income is left over. So again, a 50% DTI is going to be much more risky than a 40% DTI because of that financial pressure that borrower could be under. So I've covered a lot there, John. I know you've got some highlights that you wanted to add, or some things that you thought were. I
think the really important point you made is that a loan isn't just a loan anymore. A loan has an identity, and here's a lot of identifiers. I mean, loan amount's another identifier. All those things have now really conspired for the second investors in the capital markets to try to slice and dice the stuff up to really figure out how can we bring more value to our investment by really understanding, as Bill said, the behavior and the performance of all these different attributes. So loan attributes or characteristics, hugely important, both from a go-to-market price standpoint and from an investor standpoint. And this is where you get into the weeds. It all matters. It all matters a lot. And I through the whole loan process, through to the loan sale. Hey, Bill.
Thank you, John. You see my lips moving. I was trying to be courteous.
You said something bad about me, but I'm not sure.
Not yet. Okay, let's move on just to loan sales. So these are some of the most critical elements that John and I thought we would highlight. And John, as we go through all these bullets, feel free to add your thoughts along the way. Totally open to that. But let's start with best efforts versus mandatory execution. And this really captures the two main types of executions that are available in the market. Back when John and I were at Fannie Mae did not have a best efforts alternative. Everything back in those days was mandatory. So everything had a pair off risk or a non-delivery risk to it. But now the aggregators and the GSEs have a best efforts option. And what does that mean? What it means is that the originator and the seller is going to make their best effort to shepherd that loan through the process. And ultimately, when the loan closes and after the loan closes, they're going to deliver that loan to the investor. Best efforts is a legal term, but it does lull people into sleep sometimes, thinking that, well, I'll just do my best. And what it's not designed to do is allow the seller to game the system. So if the market moves in your favor and you're able to take out a trade somewhere else and get a better price, it's not designed to support that. So there really is no free lunch here. The aggregators and the agencies will monitor the performance. So as you're taking out a best efforts trade, the price of that best efforts trade is going to be lower than a mandatory trade, because the buyer is actually taking on that interest rate risk, and they will be hedging that loan. So your best efforts trade becomes a part of the buyer's pipeline, and they would then hedge as though that loan is in their pipeline. So they're charging the seller, and that is factored into the best efforts price. That average spread is typically around 20 to 25 basis points. It doesn't cost that much to hedge, but that's typically the spread between best efforts and mandatory execution. So again, that hedging cost is built into that trade. Performance is still monitored, so they're going to monitor your pull-through percentages. They're going to compare you to the peer group. They're going to compare you to the market. And if you are gaming the system, and if you're not, your pull-through rate happens to be much lower than your peers for whatever reason, there will be pricing implications, and they may actually terminate the relationship. So it's something definitely to monitor very closely and honor that flexibility. And then on the mandatory side, that's what it means. So you take out a trade, you are required to deliver that trade. And if you don't satisfy that trade, there is a pair-off fee, there is a penalty. And I don't want to get into the cashback pair-off, if you're in a positive position relative to market movement. But what's important to understand is if the market has movement with a mandatory trade, that there is a pair-off. There is exposure there, financial exposure, that needs to be considered as you're making your best X analysis. So, John, I know that you and I spent a lot of time training on best efforts and mandatory. I'm sure you got some other thoughts you wanted to share.
No, I just think mandatory, you're obligated to deliver something. And best efforts, you make your best effort, and it's a little bit of a gray area, but you have that, I'll say, moral obligation, if not contractual obligation, to deliver if you do fund the loan. And
yeah, I agree.
Most correspondent lenders will offer both executions. So you have that option as a seller. You may decide that, hey, this portion of my business, I'm going to sell best efforts because I'm not really sure. And this side, I want to do mandatory sales and I want to hedge that myself. So it's great that you have those different options with correspondent buyers, including the GSEs now, as you mentioned.
Yeah, good add. All right, cash versus MBS. When John were in the business early on, there were a lot more entities doing mortgage-backed securities. But changes have been made to the system as far as passing on, some of the spec loan payups. Those are being passed through via the cash window. There's also the leveling of the playing field that has reduced the spread of cash versus MBS. So currently, the vast majority of sellers are leveraging the cash window. The larger, more sophisticated entities are doing mortgage-backed securities. But one thing to be aware of is Ginnie Mae actually does not have a cash window. So if you're doing business with Ginnie Mae, you have to be sophisticated enough to issue your own securities. And so that's just something that sellers need to take into consideration. So what does it mean? So if you sell a loan to Fannie and Freddie or the Federal Home Loan Bank through the cash window, you are actually delivering that loan and they are paying you cash for it. If you're using MBS, you could either do a swap and hold, where you're delivering these loans into the TBA, creating a mortgage-backed security. You could hold that, or you could do a swap and sell, where you create the MBS and then sell that into the open market. The most typical is to do a swap and sell for the most sophisticated players. So those are the two options. But again, the most common today, for a number of reasons, is the cash window. Just much less complexity, very flexible. There's no minimum pool size like you have with MBS, so it just it has made it much simpler. And then on the retained versus release, that's the world that I live in. That's the servicing MSR, mortgage servicing rights world. SRP stands for servicing release premium. With retained execution, the seller is basically keeping the servicing asset, or the MSR. So when they sell to the agencies, they are taking a spread off the note rate, and the minimum is 25 basis points for fixed rate and 3/8 for ARM. Although the fixed period ARMs is also 25 basis points, but I don't want to complicate things around that. But the short-term ARMs is 37.5 basis points. But most of the business that we see is at the 25, so that's mostly the fixed rate business, and the servicer is being paid to perform that function and collect the payments, loss mitigation, compliance, all of those things. That's a cash flow that they would receive every month for performing that function. And then with released execution, that's when the seller is actually selling the loan to an aggregator, and they're also selling simultaneously the servicing to that aggregator as well. The other option is co-issue, where they can actually sell the whole loan to the agencies and then simultaneously sell the servicing via a co-issue arrangement. So that's also another option that's available in the market. So, John, I'm going to stop there again and see if you had anything to add there.
No, I think it's really important to think of a loan as two assets. There's the loan asset, so 4%, let's say 6.25% mortgage. There's a loan asset, and then there's a servicing asset. Both those things have value. So there's value in the collection of the payment, and you get paid to collect the payment, as Bill said, 0.25% typically. And then there's a loan asset, and those things can be sold together or apart. And I think that's really important if you're talking mortgage servicing, right? So does that mean that is an asset, that is an income stream that can be bought and sold separately from the loan?
Yep. Great clarification. All right, hedge versus uncovered. So uncovered would be when you have a loan in the pipeline, the rate has been, there's a rate lock. So you as the originator, you have created interest rate or market risk on your balance sheet. And you don't do anything to address that. So you have the interest rate risk, you have the market risk, but you're not doing anything. That would be considered uncovered. A bank might do this if they're planning to put the loan in portfolio. They're already saying, I'm okay with the risk, or a credit union. I'm not going to sell this loan into the secondary market, so it would be common for them to go uncovered. Hedging, on the other hand, when you are accepting that interest rate risk, that market risk at the point of rate lock, you're taking out a position. And the most common is to leverage TBA securities, to be announced securities. And what happens is, again, to protect the underlying margin, that's the objective of hedging, it moves in the opposite direction of the value of the underlying loan. So if the value of the loan is increasing, the value of the TBA is actually decreasing. So you want to end that scenario even so that you're protecting your margin. The opposite is true as well. So if the value of the loan in your pipeline is going down, the actual value in the market of that TBA position is going up. So it's never perfect, it's never one for one, but it's the most efficient vehicle that exists today. Some people would use forward trades, some might use options, treasuries, but the most efficient and the most commonly used currently is the TBA security. So with that, John, I'm gonna turn it over to you for the final poll.
Yeah, it's just rate locks. So, gosh, we talked a little bit about rate lock before, and it's just super important to the whole buying and selling of real estate. The borrower applies for a loan, they get approved for a loan at 6%. They can't afford an 8% mortgage, and if rates go up, they may not qualify anymore. So rate locks are super important. If you got a 45-day escrow, you're probably going to want a 60-day lock to be safe. And that borrower, the lender, all you out there are going to guarantee that borrower that 6% interest rate for that 60 days. And it's fundamental. So now the borrower has the right, but not the obligation to fund that loan at 6%, right? And if rates go down, you might try to renegotiate that 6%, but if rates go up, guess what? You're going to be giving that borrower a 6% rate. So that's the whole premise of why we're hedging, why we're here, why we do hedge advisory and all that, is that interest rate risk that lenders assume to facilitate borrowers getting a loan at the rate that they applied for. Pull-through is super important because you're a lender, you take applications, some of them are going to fall out, and you need to understand what that percentage is because you don't want to hedge or cover the interest rate risk on loans that don't fund, right? So let's just say roughly out of 100 loan applications, 80 or so will fund. But there's a lot of variables that can go into that if rates change or home prices start going down or whatever, appraisals don't come in at full value. That can create a lot of volatility and pull through. So in secondary marketing, the hedging, trading, all the things we do at MCT, we're looking at pull through rates all day long to make sure we understand how much do we need to hedge so we can hedge efficiently. And then investor outlets, what I'll say here is just look at the top. Best efforts and mandatory, cash, MBS, retained, release. What is that? 6 different variables. Investor outlets will handle all those different variables. So your capital markets team is looking constantly at all these investor outlets saying, okay, am I going to do best efforts or mandatory? Am I going to sell for cash or create my own securities? Am I going to keep the servicing or release the servicing? And that decision may be made on every single loan that you all produce to try to maximize margins and profitability for the lender.
Perfect, John. So I'm going to pick up the pace here a little bit because we got a couple of slides that I really want us to have plenty of time on, John. So I'm going to roll through the next couple pretty quickly. So we're on to the cash window now, Jess. Next slide, please.
Yeah, I'm reading a couple questions here. Want to make sure we get these answered. So there's one question. It says, what are the key differences between retail and wholesale channel from the perspective of a non-QM aggregator buying loans from originators? That's from Stephen Lee.
You want to take that, John?
Well, we got into non-QM. We'll talk a little bit about non-QM. I'll try to answer the question. So non-QM would be loans that don't typically fit the standard Fannie Mae, Freddie Mac, FHA, VA type of box. And because those loans are qualified differently, the underwriter's trying to figure out the ability to repay as opposed to certain agency guidelines. So those loans make sense, right? The borrower may have a lot of assets or whatever, or maybe they're self-employed for a short period of time, but they've got a lot of down payment. So the question had to do with retail versus wholesale and the execution for that. Non-QM has also exploded. It's a whole nother line of business that has, I'll say, exploded or come to a great fruition. And what I think is super important about that is that the capital markets have recovered such that those loans can be made and not sold to the agencies, but securitized and sold in the private markets. So that's done through retail and wholesale. I don't know if there's a big difference on the offerings between the wholesale side and the retail side as it relates to those mortgages. There's a good number of conduits that we haven't mentioned, Figure, Spring EQ, and the many non-QM lenders that specialize in that business. But I would say it's the good news is it's giving a lot of borrowers a chance to get mortgages that otherwise would not have. I don't have much more than that. Bill, do you?
Yeah, I would just add, John, that for non-QM and QM, you can see originations come out of all 3 channels currently: retail, wholesale, and correspondent. So it's not currently limited to any one channel. And then with some of the affordability challenges that we've had in this country for the last several years, non-QM is emerging. Yeah, because it does allow some flexibilities that conventional mortgages and GSE eligible mortgages don't allow for. So you're seeing growth in that non-QM space. So I hope that answers the question. And Jess, was there another one?
Yeah, we actually have a handful that came through on the last slide here. So next question is, what are the key differences in transaction between table funding originator and originator funding the loan via their own warehouse line at closing?
John, that's as head of secondary, that'd be yours.
Get one more time for me, if you could, please.
Sure. What are the key differences in transaction between table funding originator and originator funding the loan via their own warehouse line at closing?
That's Gosh, to be honest, I am not the expert on that.
We can
Yeah,
we
I'm not
can
either.
follow up. Yeah, after the
Yeah,
webinar, send a
we
personalized
can come back to it.
answer. Yep. Okay, next one was, how do we quantify or incorporate risk in terms of mortgage types?
How do we, so that's something that is built into the guidelines that the GSEs establish. So in order for a loan to be eligible to be sold to any investor, but the GSEs sort of set the foundation for the parameters of loan eligibility. And we were planning to talk about that a little bit later, but all investors are going to have their own parameters as well. They may have carve outs, they may have areas where they expand beyond where the GSEs are. And all of those are done intentionally to mitigate the risk. And they may have pricing adjustments that allow you to take on a little bit more risk, or the borrower to go beyond what the GSEs are allowing as far as their eligibility parameters. So it's all sort of a risk mitigator and then price adjustments to address whatever additional risk is accepted on that particular loan. So that's how I would respond to that. John, do you have anything else to add to that?
I would add that that's, we're very focused on the Fannie, Freddie, GSE space. They have prescribed loan level price adjustments. In the FHA, VA world, there are no prescribed price adjustments for credit score, loan amount, or anything like that. So the investors will make adjustments based on their perception of risk. And also portfolio lenders, whether you're doing first mortgages or home equity loans, you're faced with or have the opportunity to price risk as you see it. And that we went through all the attributes that could possibly have risk adjustments. So those portfolio lenders, they're responsible for the risk. They need to get paid for that risk. So they're motivated highly to come up with their own adjustments, which could be much different than the GSE, the Fannie Mae, Freddie Mac adjustments. And they will apply for non-owner mortgages. It's going to be a 0.25% higher rate. For cash out, it's going to be a quarter higher. For credit scores of between this and this, maybe 0.5 point higher. So very robust area, and why the loan attributes matter a lot to investors.
Thanks everyone thanks everyone for your questions. We're getting a few more. We're running short on time though, so I do have these on the back end. We will follow up with you all directly to answer your questions after the webinar. Or if there's time at the end, we can circle back. So I'll hand it back over to you, Bill.
Yep, John and I will get back to you. So we appreciate the questions, and we'll certainly work on them. But let's move on, Jess, if we could. And I'm going to pick up the pace here a little bit. This is simply an example of what the cash window with Fannie Mae looks like. You can see that there's a mandatory best efforts option. There's a number of days. You can see 7 days there. The loan amount, or the amount that you're actually going to be delivering. There's the pass-through rate. And again, the pass-through rate would basically be the note rate minus the servicing fee. So again, this is just an example of that. As far as like, why would you take out a 7-day versus a 45-day? It really depends on where that loan is in the process. So if the loan is already closed, you're ready to sell it, you'd want to take out a shorter commitment period. If the loan is in the pipeline, you're not really sure, you probably need another 30, 45 days, you might take out a 45-day commitment. So that's, again, just an example of the cash window. And let's move on to the pricing. So this is just an example of what that cash window pricing looks like. And note that this is all in percentages. So for example, and please note that these are just examples off of the Fannie Mae website, and these interest rates are outdated. But for example, if you had a loan that you were delivering, and in today's market, let's say 6 1/4 is at par, and you're delivering that 6 1/4, that's 100. But if you actually had a note rate that's a little bit higher, let's say it's 6 3/8 and the price is 102, if that loan was actually a $100,000 loan and you're delivering that to Fannie Mae or Freddie Mac through the cash window, they would be giving you 102,000 back. So that percentage is applied to the unpaid principal balance. And then the opposite is true. So that would be considered premium pricing. Par would be at 100, and then discounted would be, for example, at 98. So if the interest rate that you were passing through was below the current market, below that 6 1/4, let's say it's 6 1/8 or 6%, you're going to receive a discounted price. So that might be at 98. So if $100,000 loan, you would receive a 98,000 in return for that. So again, this is all in percentages and basis points, and then we're going to turn it over to John real quickly to talk about the MBS pricing screen on the next slide.
I'll just say that this is the foundation. This is a trading screen where investors buy and sell mortgage-backed securities. This is the foundation of the mortgage market, the 30-year fixed rate mortgage that we know and love. You can see the bid offer spread here. This is a live screen. You see some red on there. That means mortgage prices are down. They're quoted in 30 seconds, mortgage-backed security prices. So this is the screen where all the secondary market folks are buying and selling, hedging, and conducting those TBA trades that Bill mentioned.
Excellent. All right, we're going to keep rolling. So now we're moving on to the market impact, and we've focused a lot on the GSEs, and I think not only the GSEs but Ginnie Mae, because they are the foundation of our secondary market system. They really provide the backbone and the liquidity into the system. But I think we've talked at length about who they are and what they do. John, I'm thinking that we actually go to the next slide and talk about some of the implications of the Great Recession, at least to give us a few minutes to talk about changes that were made as a result of that event. So that was really historic. You okay with that?
Yeah, let's do it.
Okay, so let's talk about this. So after the Great Recession, financial crisis, you can call it what you want, following 2008, there was a great focus on regulations. So the GSEs obviously had some financial challenges. Their underlying loan performance took a big hit. They had substantial losses. As a result, the FHFA was established. That's the Federal Housing Finance Agency that in the current status that both Fannie and Freddie are in, they're in conservatorship. It means that the FHFA has oversight authority, so they're monitoring them much more closely than they would have been previously. Additionally, there was a dramatic increase in the guarantee fee. So as a result of the losses that were occurred, it was obvious that the guarantee fees that were being charged, and John, when you and I were in the business, fees were generally in the mid to high teens, and now they're in the 40s, up around 50. So things have changed a lot. There was also the leveling of the playing field. You know, back in the early, I would say the early part of the 2000s and late 90s, you saw a pretty substantial difference between the guarantee fees for the large entities and the small entities. So the FHFA put an end to that by leveling the playing field, where not only the cash underlying guarantee fees, which is called notional fees, and the guarantee fees have to be level within a fairly small amount, and they do a study every year or two that confirmed that the spread between the largest and the smallest is very low. It's like 1 to 2 basis points. And then risk aversion. You know, LLPAs became much more rigorous. The loan parameters became tighter, and adherence to the charter was certainly something that was much more focused on. The LLPAs have been in place for a number of years, but it was expanded, and the levels were increased pretty dramatically. And John, I can't even remember if I was supposed to hand off
no, I'll point out that guarantee.
We're going to share this one. Let's go ahead.
Yeah, I just want to say guarantee fees for folks. That's the insurance premiums. Fannie Mae, Freddie Mac, they're insurance companies. They insure mortgages, and they guarantee the performance of those. So those guarantees are insurance premiums. As Bill said, the insurance premiums, tripled, right? Over after the price of insurance went up. Non-QM, we talked about that before. Reduced documentation. So I'm at a conference right now, and I remember at a conference some years ago before the financial crisis where people were talking about stated income loans. You see this no income, no assets, stated income loans, no doc loans. They called those liar loans, and we suffered the consequences of those. So you see the non-QM, QM, you see all the regulation that Bill's been talking about. You see the increase in insurance prices for mortgages. That has all conspired to make the mortgage market much more stable.
And a few other things, the prepayment penalties, that's no longer a part of a conventional eligible mortgage, but you'll still see prepayment penalties with non-QM production. And then the CFPB, that was introduced in 2011. The CFPB is really responsible for protecting consumers in the financial marketplace. And, there were a lot of lawsuits as a result of these reduced stock loans that the CFPB is striving to eliminate. And then the mortgage-backed security. It used to be the Fannie Mae mortgage-backed security, and then the Freddie Mac PC. It's now the uniform mortgage-backed security. They both have the same delivery period. They have the same legal docs and the same payment delay. So these are some substantial changes that were made as a result of the Great Recession. So our apologies, guys, for going over. We welcome your questions. If you have any afterwards, we'll send out this deck and this presentation to you all, and welcome the opportunity to engage with you separately. But we appreciate everybody joining us. Hope you got a few things out of it.
Thank you very much.